What's up, guys? I hope you're doing well. So I came across something that I thought was pretty interesting. Like it's called the WEI, the Weekly Economic Index. And from what I can tell, one, I might speak a little slower because I'm going over to the screen share. And sometimes when I'm tired, my brain just can't talk and operate at the same time. But basically, what it is, and I'll change the. There we go. So it looks a little bigger for you guys. So basically, it provides a signal of the state of the U.S. economy based on data available at a daily or weekly frequency. And so I get because a lot of the times you have these numbers, right, that only come out. Some of them are annually, some of them biannual or semi-annually, and then all the indicators and stuff like GDP, CPI, GDP deflator, um, all any other ones you can think of that require like data and research and stuff that normally comes from the Federal Reserve or some other monetary institution or whatever it may be, whatever case. Um, some of them can come up daily or weekly. And so this is basically what this is going on about. And it seems it's basically like general economic data, it seems. So it represents the common component of 10 different daily and weekly series covering consumer behavior, the labor market, and production. So kind of the nitty gritty, right? And so it said the WEI, and I am trying to refrain just from just calling it the we because I just think that's funny. But anyways, the we is currently 4.14%, and this is all scaled to four-quarter GDP growth for the week ended May 14th. So this past week, or yeah, because this is no, it'd be 2 weeks ago, it seems, and the second week of May, and then it was 4.29% for the previous week before that, right? And so as kind of a reference too, it was at 1.37% for the week ending in the end of February 2020, which was right before the pandemic started and everything else when it was getting over into like America and stuff. And so you can also tell it seems like it follows the general trend of GDP, but to where it's a daily and week, like it uses daily and weekly indicators. It's much more uh, uh, volatile wouldn't be the word, but there's much more data points, and so you can see those changes much more quickly, right? So any significant change in the economic activity, right, would much more quickly manifest itself in this measure. You can tell this by like this complete drop off, right, um, in the end of February and then March 2020, where it goes down, and then kind of GDP slowly goes down because you can see there's only 2 points in that same time series, where you got one in March for the Q1 and then two in June, end of June, for Q2 and so on, or maybe July, whenever it comes out. But you can see the difference, and there's much more points in between in the same kind of time duration um, for the Wii. And you can kind of see the same thing it starts to increase, and then it increases much quicker too, as it did in the beginning of 2021, and now it's kind of leveling off slash going down. Um, and the thing I love about these Fred charts, or however they make them, I don't know if this comes from Fred. Probably not. It's probably from the it seems like they use maybe like the same software or whatever, because the Fred charts are made from the St. Louis Federal Reserve, and this comes from the Dallas Fed website. Um, See if I can actually interact with it and maybe change. Apparently not. Nope. No, so that part's just a screenshot, but it does take me to an interactive page if you click on it. So I'll switch that over in a second. But yeah, basically says the decline for this week, obviously relative to the first week of May, is due to decreases in retail sales, steel production, which is relative to the same time last year, tax withholding, railroad traffic, The rise in initial unemployment insurance claims, which more than offset increases in consumer confidence, electricity output, and fuel sales. And so it kind of decreased a little bit. So there's that. And we will see how relative this is. And I'm going to try to share my screen, just share the whole window so you guys can see what popped up when I clicked on it. Over here. So this is the interactive one when I clicked on it. So whenever I clicked on it, when I was on the previous tab, it brought me to this page, which seems like it's just an actual interactive part, and I can actually scale it and such. So it seems like I can go all the way back out to probably around 2008 to mid 2009, somewhere in there. That area, well, I guess January 5th, 2008, somewhere in there. Yeah, there's the date. But you can see this kind of decrease. And so it's kind of looks like it's about the same level. Let's see. It was 4.38% in mid 2010. And then it's a little bit lower, or just it's around the same level as it was back then, within a few basis points. But you see this kind of massive relative to the whole thing. You can see the kind of dip down during the recession, and then it comes back up, and then it kind of stays level for the entire time, at least relatively. And then basically the next recession, and it dips down, and then like overcompensates, and like it seems like it's like the same. It's almost a perfect reflection, where you kind of have this. It's not even dead center, but I don't know. I'm trying to word it correctly, but either way, whenever it dips down or whatever, it like overcompensates and goes too high, and then it kind of comes back down and levels off for a while. Same thing happened in 2020 with that recession, and so on. I don't know. It's pretty interesting. I don't know if you can get this for each one where it gives you the commentary like what I read on the previous slide. You might just be able to. Can I just click on a? Yeah, you can just click on stuff. Okay. So in that case, we will get rid of that chart. So we're only looking at this one, and then you can click on the dates, and it'll give you the commentary. It seems, with the revisions as it comes afterwards. So it's pretty interesting. I might actually spend some time and look more into this chart. It was revised downward due to an increase in continuing unemployment insurance claims, and it gives you the reasons I think it is, the dates, and which revisions they were. That's pretty cool, actually. And this is from the Dallas Fed. Well, how I originally got here was from the Dallas Fed. And so this chart, when I clicked on it, is actually from the New York Fed. And so did I just overlook that in the lightly gray fine print? The source is the author's calculations based on other stuff. Does it say anything about the New York Fed in here? BEA, Bureau of Economic Analysis. Anyways, you can click on this chart and it'll bring you here, and then you can really play with it. It's pretty much the best way to learn this kind of stuff, at least from what I've noticed. It's how I've been learning most of it. You can add annual real GDP growth, and so it really reflects real GDP, apparently. And then it has a 13-week moving average. So yeah, it's pretty cool. Stop the screen share. Anyway, that's pretty much all I got for this one. I kind of just wanted to share it, and it turned out to be a lot more interesting than I thought it was when I first found it. So I hope you guys enjoy it. And yeah, that's all I got for this one. So I'm going to play around with this chart more. And then I hope you guys have a good night.